curve remains deeply negative, and this is real yields as they're traded in the market via tips. But you've got to remember, if you take any spot inflation figure, any inflation print this year versus anywhere in the curve, yields are really deeply negative right now. This is just about they're trading to be a positive or trying to be a positive inflation over the longer term horizon. So on the spot basis, yields are still deeply negative. And I think this is something I'm going to talk about later on in the show. Financial conditions have tightened a lot over the last 6 months because of the shift higher in yields, but they remain exceptionally loose, especially when you take into account some of those more bubbly elements that provide a wealth factor, things like housing market, the tech market, Bitcoin, crypto, meme. Those kind of things provide a wealth effect. And overall, financial conditions are still very loose when you look at a much longer term basis.
Yeah, and you also look at housing starts yesterday in the U.S., the highest since 2006. So the data's still coming in strong, Mark. But, not to belabor the point, but if we set spot aside, looking at the tips market, looking at this 10-year real yield at one point turning positive, is there any effect? Is there any sort of mechanical element of that psychological level being breached?
I think it is important. I think it's, because many people thought that we wouldn't get to positive real yields anytime soon, just be given the debt piles that the governments have an incentive to inflate away. So I think it is a psychological turning point. But, if through most of the trading history up until the last kind of 10 years or less, the idea that, hey, positive real yields in the 10-year are flat and they're deeply negative at the start of the curve, that would have been risk on, risk on, risk on. So yes, you're right that where we've come from is a little bit of tightening. But as I said, these are still very, very low yield levels. The point is, where do we go from here? Are they going to continue to go much higher? And I do think that real yields will go higher from here. I think that at some point, the Fed is going to have to get much more aggressive in this market. But these things don't go in a straight line. And the move we've seen in real yields over the last month or so has been really quite exceptional in terms of the pace. So maybe we're due a little bit of a slowdown, maybe not, even if not a reversal in trend.
Mark, at the risk of doing yen bashing for the second day running, maybe we can escape the yen bashing today. We are looking at a stronger Japanese currency today, despite the fact Japan is yet again unleashing this bond buying. Has the trade finally run out, or are we about to see yield curve control ultimately fail?
You can never do too much yen bashing. There's always time for more. But on a longer term basis, no, the yen bearish trend has not run out on a longer term basis. Short term, I have no real conviction. And over the last 24 hours, there's been a lot of publications showing how the extraordinary move we've seen in the last 15 days is really quite unprecedented in terms of number of days of losses. So short term, sure, it might run out of steam soon, but later on this year, the yen will weaken much more again.
All right, well, the bearishness continues for the yen. I hope you're not breaking any yen bull hearts out there. Mark, thank you so much. Remember, you can stay up to date with analysis from Mark and the team, and Live Go on your terminal is where you want to head. Now let's get the Bloomberg First Word News. Laura Wright standing by in London. Good morning, Laura.
Good morning, Danny. Russia has launched what